managing your 401k, it's really managing your retirement accounts, whether they're IRAs, 401ks, simple plans, whatever the case may be. Really long-term investing is what we're talking about here. But specifically, we're talking about managing your 401k and COVID-19 and market volatility as things continue to be crazy in the market. I want to make sure that we do a couple of things here first. First of all, as I said a lot in our last webinar, but reiterate again today, clearly the most important thing right now is everybody's health, and we worry about everyone. We want everybody to be well. The most important thing and the most critical thing going on right now is caring for everybody around the world, and so we don't want to minimize that at all. I continue to say, as much as I want the economy and the market to do well, I want people to do well and be healthy long before that. So I don't want to minimize any of that kind of stuff. But having said that, it does affect the economy, and it is affecting our 401k retirement accounts. And so we want to talk about that today. So let's talk about it. First of all, a couple of things that we're not going to do today. No idea when the coronavirus, COVID-19, is going to be contained. You know, you guys are reading it just like I am. Who knows when this stuff will end? Hopefully sooner rather than later. We'll keep our fingers crossed and keep praying both ways. We don't have any idea how the markets are going to react, and we don't have any idea where the markets are headed either in the short term or the long term. I have confidence in the long term, but I certainly am not going to make any predictions about what I think is going to happen. Certainly in the short term, I'm not going to make any predictions on what I think is going to happen. It's all over the place. It's a complete guessing game. And I think if you try to guess it, if you try to time it, you're going to be wrong, and that's a loser's game. So that's what we're not going to do today. Let's talk about some of the things. These are the things we went through last time. And when you're talking about retirement savings, retirement investing, you know, what are some things to really continue to be focused on? And really, these things don't ever change. And you're going to hear us say the same thing over and over again. And for those that we've worked with in the past in the 401ks, you've heard all of these before. Just to run through them, a couple of them, and then we're going to focus on a few of them specifically, because a couple of them have become really hot topics over the last couple of weeks. You know, this has happened before and will again. I didn't change that when I could have changed it. I'm not trying to be insensitive to COVID-19. What I mean by that is the markets have crashed, gone down, taken these dramatic spikes both ways before. It will happen again. Recessions have occurred. They go away. They'll come back. These types of things have happened before, maybe not specifically to a pandemic, but certainly we've seen these things kind of happen before, and they'll happen again. Really focusing on the basics. We want to buy low and sell high, not the opposite, right? Everybody says that, but very, very few people are able actually to do that. Right now, the market is low. Certainly it's low as compared to where it has been for the last couple of years and even the last 6 weeks. You don't want to be selling right now if you can avoid it, right? Buy low and sell high. We're going to stay away from timing the market. Again, we just talked about it, and this last couple of weeks has been a perfect example of what happens when you try to time the market. We want to stay away from that. All of the money managers that I respect and follow say, you know, timing the market is a loser's game. You don't want to do that. Yes, things are going down right now. But the question is, how far will they go? When will they pop back up? Where will they pop back up? We just don't know. What we know is history has told us if we just stay in the game, it has worked out for us. And I believe that's going to happen again. You know, avoiding emotional decisions. This is probably the hardest one right now, because gosh knows, you can't turn on the TV, read Twitter, however you get your news. It seems like it is bad news, and it is very easy to get emotional. It's very easy to react to that. We want to not do that. Avoiding emotional decisions is a key here.
Welcome to Zoom.
Again,
enter your meeting ID followed by pound.
Hold on, I'm gonna mute everybody again just to make sure. All right, I think you got everybody muted again. So we're going to avoid emotional decisions. Don't let short-term results affect long-term strategies. Sticking with your plan. We're going to talk about that again here in a minute. But as you've heard me say many, many times when it comes to your retirement account, especially, what does it matter really what your balance is when you're 37, 47, even 57, really up until the day you get ready to start spending it? We're not going to let short-term results affect our long-term strategies, riding it out. Don't let the media scare you. That kind of goes back to avoiding emotional decisions. I'm just trying not to read anything right now. One of the things we've heard a lot recently over the last couple of weeks is, well, I've lost X amount of dollars. And it's somewhat semantics. It's not meant to be a smart aleck, but we say, did you lose money or did you just lose value? We're going to talk about that again here in just a second about what that really means. And again, going back to sort of the long-term results, short-term results, were you going to spend your 401k dollars tomorrow? If you weren't going to spend them tomorrow or any time over the next short term, what does it really matter what's happening right now? It's not fun to watch necessarily, but ultimately it doesn't really affect you until the day you get ready to start spending it. So let's deep dive a little bit into a couple of those, because those are things we've all talked about before. And again, I think no matter the circumstance, no matter the reason why the markets go up or down, we always come back to these basics of picking a sound long-term strategy, not making emotional decisions, buying low, selling high. These things don't ever change, and they're not changing even given this pandemic. But let's take a deep dive into these a little bit, because we've heard a couple of them a lot recently. So this is kind of time in the market. I thought this was interesting. Now, you can make numbers say whatever you want them to say, right? But what I wanted to pull here was, this is the Dow Jones closings for 4 days over the last month. We took a big dive at the beginning of March, right? There you saw it was 26,000 on March 2nd, and by March the 12th, it was down to 21,000. But you see March 12th, again, by the way, that feels like years ago at this point. So over the last 3 weeks, look where it's kind of wound up. Even with all the volatility going all over the place, we're really pretty close to where we were on March the 12th, right? It's about 1% difference. If you had just stuck it out through the last 3 weeks, not made emotional decisions, despite all the up and down, you would have really been about the same place that you are anyway. The key would have been what days are going to go up and what days are going to go down, and how do you know when that's going to happen? If you were trying to predict it, you would have missed some really, really good days over the last 2 or 3 weeks. I think it was March 13th where the market was up almost 10% in just one day. We don't know when those days are going to occur, but what's interesting about it is even with all that volatility over the last 3 weeks, we're really in the same place we were when we started. Now, having said that, try not to watch the market every day. I encourage you guys not to watch the market every day. It's down again today. It's going to be volatile. I think this whole environment right now just breeds volatility. We're going to see it continue to be volatile. I think I said I wasn't going to make predictions. That's not really a prediction of where I think it's going to go, but as much as I think it's just a prediction that it's going to be volatile. But interestingly enough, over the last 3 weeks, we're kind of in the exact same place we were. So time in the market just doesn't work. And let's think about long-term strategic thinking. Now, I thought this was interesting. This is a fellow that I follow. His name is Azim Azar. And you may not know who Azim Azar is, but he's a pretty highly thought of thinker, economist, whatever you want to call him. Has a great podcast that I listen to. And Azim interviewed a guy named Nouriel Roubini, who is also, you probably don't know, but is a world-renowned economist. He's actually called Dr. Doom, is his nickname, because he tends to be very gloomy with his forecast. And Dr. Doom was interviewed just the other day by Azim, and he's not real positive about what's going to happen with this coronavirus economically. So that's the bad news. But what's interesting is I thought the statement there that you see in the middle of your screen was interesting, where it says, even under optimistic conditions, the recession that Dr. Roubini is predicting is going to last 2 to 3 quarters. And by the end of the year, there'll be some light at the end of the tunnel. I started thinking about that after I read it, and I thought, that's not great news. But in terms of retirement planning, 2 to 3 quarters is 6 to 9 months, right? We get into 2021. Even Dr. Doom says by 2021, he thinks we're likely to start coming out of this. Well, that's not real long in the grand scheme of things, and it's certainly not very long in terms of retirement planning. I mean, if you were going to retire in the next 2 to 3 quarters, this is affecting you. But if you weren't going to retire for the next 2 or 3 quarters, if you can ride out 2 to 3 quarters, even Dr. Doom is saying that he thinks that there is going to be light at the end of the tunnel. That's not real long, and so I just think there is somebody who really is gloomy on a forecast. For every one of those, you have other people saying, no, they think it's going to spike back up here relatively soon. I don't have any idea what's going to happen. And I don't think anybody else really does either. But I know that this too shall pass. Even the ones who are predicting really bad things, they think it's going to pass. They believe we're going to rebound. When we're going to rebound, nobody knows. That goes back to the last slide of trying to time the market. but long-term strategic thinking is the key. And 2 to 3 quarters in the grand scheme of things really doesn't matter what any of us are doing. So let's go to this one, because this is one that I've heard a lot over the last couple of weeks. And I will tell you that I have said the exact same thing. Did you really lose money? So a lot of us are checking our accounts, right? And over the next couple of days, we're all going to be receiving our first quarter statements in the mail, and they're not going to be pretty. All of you know that already. The markets are down across the board. We just looked at where the Dow has gone just in the last month. So I've talked to a lot of people that say, wow, well, I've lost X amount of dollars over the last 3 weeks. I've lost X amount of dollars since the 1st of February, 1st of March. Well, let's talk about that for a second. So here's a statement. Bob Plyben, who is our CEO, who I believe is on this call. This goes back to March 9th I said 2020, sorry. That's supposed to be March 9th of 2009, which was in the teeth of the recession. I believe March 9th was about the worst day, the bottom of the market during the recession. And I was, you guys have heard me share this story a lot, when I was kind of hemming and hawing about my own account, which at that point was down 62%, by the way, from where it had been 2 years earlier. And I made the comment that I had lost a bunch of money, at least certainly a bunch of money for me. And Bob said, wow, that's too bad. You lost how much? So where did it go? And I thought for a second. I said, well, what do you mean, where did it go? And he said, well, where did it go? I said, well, it was in my account. Now it wasn't. And we talked about that. He also went on to say, and we're going to spend that money tomorrow, which obviously the answer to that was no. But let's talk about, do you really lose money? And I think everybody on here has a pretty good handle of how this works, but I want to go back just to the basics of sort of mutual funds and how they work exactly, because I think this is very, very important. So most of our retirement plans are made up of mutual funds. What a mutual fund does is it goes out and it purchases stock in lots of different companies. And in this example, we have the American Funds Growth Fund of America. It holds 334 companies inside of that fund. So if you're in the Growth Fund of America, and this isn't me advocating for the Growth Fund of America one way or another, but if you're in the Growth Fund of America, really what you do is you hold tiny little shares of all the companies that the fund has. And so when you contribute money to that fund, you're actually purchasing a share of that fund, or sometimes, depending on the type of plan, it may be called a unit, but a share of the fund. You're buying a share of the fund, and then those fund shares go up and down in value. And so when the market goes down, the shares you own lose value, but you don't lose the shares, right? So let's say you bought in at $10 a share, you bought 10 shares, and then all of a sudden those shares are worth $8. So now you still own 10 shares. It's just, as opposed to being worth $100 like they were worth before in total, now they're worth 80. But if you could wait it out, and as those shares come back and gain value, which they always have in the past, you get that back. So in the short term, as you're opening up your statement, yes, your value is down, but you haven't lost. You still own exactly what you owned before in terms of the number of shares. It's just that they're just not worth as much right now. And you only officially lose, right, when you sell the shares during down times. So there's a buddy of mine who's in this business who says, if you want to lock in your losses, lock it in order to lock it in, sell when the market is down, right? Which is exactly what we don't want to do. We want to buy low and sell high. Well, if you sell right now, you would be selling low, but mostly that would be the way you would lose. I hope that makes a little bit of sense, because you still own the same amount of shares that you did before. They're just not worth as much. And if you look at it glass half full, as you're contributing to your plan right now, you're buying shares low, right? Does that sound familiar? We're going to buy low and sell high. Well, right now you're buying low. So not only did you not lose any shares, but you're buying new shares at a lower value, which we think is going to work out for you over the long haul. So it's easy to say, and I totally get it, and I've said the same thing, but in terms of, did you really lose money? You only really lose money when you sell when the market is down. Again, you still own the same amount of shares. It's just not worth as much. The example I used a couple of weeks ago is I said, if you buy a house and your house is worth $100,000, then there's some kind of real estate recession. And does that sound familiar? 2008, 2009. And all of a sudden your house is only worth $80,000. Well, you don't lose your house. You don't lose a fifth of your house. Your house just isn't worth as much as it was before. But if you hold on to it long enough, hopefully it comes back in value. It's the exact same concept. You're not losing anything that you own. It's just not worth as much as it was before. Now, had this one a couple of times recently, and gosh knows it is easy to think this. Can a fund just go to zero? Could your account just go all the way to zero? Well, theoretically, yes. I'm not going to hide from that. Theoretically, it could go all the way to zero. I think the chances of that are so remote that I don't even really think about it. And let me share with you kind of why that is. So again, let's just use American Funds Growth Fund of America as an example. It holds 334 companies. And just to be real simplistic with this, so in order for the Growth Fund of America to go to zero, what would have to happen? Well, just in the top 10 holdings of the Growth Fund of America, 334 companies in the top 10, Facebook, Amazon, Microsoft, MasterCard, Netflix, Google, Alphabet, all of those are in the top 10 large companies, very important to the U.S. economy, very important to what we're doing domestically and throughout the world. So what would have to happen? Well, in order for the fund to go to zero, all 334 companies, including the ones we just listed, they would have to go out of business, right? They'd have to go all the way to zero with nobody else buying them to save them. And the money managers of that fund, of the Growth Fund of America, would have to have ridden all 334 companies down with no adjustment ever, right? So theoretically, yes, it could go to zero, but I believe that the chances of that are very, very, very small. I think it's generally what has happened. I see there's somebody coming down with a chat question. Yes, that's a good question. There is a somebody out there has said, to be fair, if you only lose money when you sell, then the converse should be true. You only make money when you sell high. That is exactly right. You're exactly right. That's a great point. Which is why also the revert, and I've said many times to people as they open up their statements and they've had a really good quarter, and all of a sudden their balance is really high. I said that's true, but again, it doesn't really mean anything until you get ready until you sell it. Right? You only lock in your profit. You only lock in your value on the day you start to sell it. But that's a very good point. And then the follow-up was, I suspect no fund managers were suggesting anyone to sell in January when the market was high. That's hard. There are always plenty of people saying different things. That's a great point, though. Again, I'm riding it out for the long term. I'm not selling anything right now. I'm not worried about really what the value is. In fact, I'm just buying more shares of all the things that in the funds that I have. But that's a good point. You really only recognize gains or losses when you sell. So again, going back to could the fund actually go to zero? It's just so incredibly unlikely that would happen that I don't worry about that at all. And what I kind of joking but not joking, what I say a lot of times about things going to zero is if all of those companies go to zero and if the money managers have no other place to go, we all got way worse problems than what's going on in our 401k. It's sort of the way I like it. But theoretically, yes, you could go to zero. I don't think it would happen. So what can you do if you really think, if you're really worried about that? I guess you could bury it in a mattress, and all of you, or at least all the ones that work with Plyman Associates, they have a mattress, they have a shoebox in your plan. Right? If you're just stressing out, if you're losing sleep over it, if you just don't know what to do and you can't decide and you just don't believe that anything's ever going to get better, you could go to a money market account right now and not worry about the market. Now, don't forget, if you go there right now, what are you doing? You're selling low, right? And we want to avoid that if you can. But if you really have that kind of outlook on things, you could still contribute to your plan and go into the money market, go into the mattress, go into the shoebox, and you wouldn't have to worry about it. But those are two questions we've gotten a lot recently. Let me say this as well, because we've gotten this question a lot about 401k specifically over the last couple of days. A lot of you have read in the stimulus package that was passed last week about some changes to 401k and how you can get your money, how access to your money. They've eased up on those restrictions, which is a good and a bad thing, right? It's a terrible time for a lot of folks. People are struggling. The economy is bad. If you have money in your 401k, you kind of break glass in case of an emergency. They've made it easier to get there. I have some real reservations and hesitations about that. I hope that we can all get through this without tapping into your 401k, without tapping into your retirement accounts. Please exhaust all other resources before you go to your 401k or your retirement account for monies to get you through this crisis. We're going to get through this, and one day everybody out there is going to retire. And when you get there, you're going to be really, really glad you haven't touched this money. For every dollar you take out now, that's just going to be not just $1, it's going to be multiple dollars that you don't have there at retirement. So please, 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 even though the rules have been relaxed, even though this is now an easier place to go for emergency money, and I get it, and if you have to have it, I'm glad you have this as an option, but please explore every other option you can before going into your 401k or retirement account to pull monies out for short-term needs. Just like we're not going to react to short-term market fluctuations, I hope that we can not react to needing money in the short term. I hope the reaction is not to go to the 401k. Because one day we're going to wake up and we're going to be through this and the economy is going to be roaring again. I believe that. And you're going to be glad you've left your money in there, and you're going to have the kind of retirement that you want and deserve. But in order to get there, we got to stay in the game, right? We got to leave it in there. So please exhaust all other options. That's a question we've had a lot. And I know everybody's considering everything, all options on the table. Please make this the last option. You guys have heard me say all of these a whole bunch of times, and we've mentioned them a whole bunch of times already in this webinar. But there's India Ree. Again, I've said I'm not sure who India Ree is, but she sang a song that says, "This too shall pass." A lot of people have said this too shall pass. This too shall pass. We're going to get through this one day. I can't tell you when, and I can't tell you how dramatic the upswing is going to be, but this is going to pass. And we want to be in a position that when this passes, we continue on and we give ourselves that kind of retirement we want and deserve. Red, the Shawshank Redemption is about pressure and time, right? It's all about continuing to put pressure on your retirement account and give it as much time as you can give it. And the more time you have, the great. But if you have less time, that's okay too. We want to give it as much time to work as possible and not mess with it right now, not make emotional decisions. Kind of going back to the glass half full, rate of savings far more important than rate of return. We've talked about that a lot. If you can continue to give to your contribute to your 401k, to your retirement plan, it's a great time to do that. Again, you're buying low. There are a lot of people out there that say, hey, if you can increase what you're giving, what a great time. In theory, that is a great thing. If you can do that, congratulations. But keep trying to give to contribute to your 401k. This is going to be we're going to look back at this time as a buying opportunity one day. So every dollar you're putting in now, you're buying low so that we can sell high later. And then I wish I hadn't saved so much money. Again, we joke about that a lot. And during this time, it's maybe not so easy to save so much, but it's during the times like this that you're glad you've saved so much. And when we get to the point in retirement, we're going to be really glad that we've saved so much money. We're really glad we didn't make emotional decisions, that we didn't react to the short-term market jitters. We didn't let the volatility scare us. We stuck to our long-term plan, stuck to our long-term strategic thinking, and it's going to work out for us in the end. Now, here's Bob and I. So there's our office phone and our cell phones and our email addresses. I'm checking the chat button again right now to see if there are any kind of questions coming up. Please email us, call us. We can do a Zoom call, whatever works out well for you during office hours. If you need to do it off office hours, let us know. We want you to feel comfortable with this. We want you to feel confident in it. And we want to be a resource for you, whether it's your 401k with Plyman Associates or things you may have outside of Plyman Associates, whatever the case may be. We want you to use us for a resource because our family is just like your family. We got a lot of things we're all thinking about right now. This is a big one for us, but there are a lot of other things going on as well. So please use us, please call us, please email us. We're here for you, and we want to be that resource for you. Let me check the chat button. All right, everybody's kind of quiet right now in the chat, so I'm going to shut up for just a second. Got an idea coming in. Hold on.
Jay.
Yes, sir.
You are unmuted.
Hold on, I'm trying to get somebody trying to say something. Bob, are you out there?
I am out here. Am I unmuted?
You're unmuted. Go ahead.
Wonderful. I just wanted to chime in on a couple of fronts. First of all, I hear a lot recently, and I've heard it a lot over my almost 50 years doing this. People say this time it's different. And it is not, it's different in that it is something different that is happening. But we've had all kinds of issues for a long, long time. I remember in 1972 when I first started, the Dow Jones ran up to 1,000. And in 1973, by June, the Dow Jones was down to 500. It lost 50% of its value. So everybody thought the sky was falling. And then in the late 70s, we had the oil embargo, and the price of oil went spiking up, and the market tanked, and it came back. Then in 87, they had the savings and loans all went bankrupt, and the market tanked. And then in the year in 2000, we had the quote .com stuff. In 06, we had the financial crisis. The point is that every time one of those things happened, the market went down, but it came back up, and ultimately it always has. Is that a guarantee? No, but you got to learn from history. The other thing I was going to point out, it was a great point someone made about you only make the money if you sell high. That is exactly. Stick to it and don't get emotional about it. My plan forces me to sell high and buy low. Could you hear that, Jay? Can't hear Jay now.
All right, guys. Bob, can you hear me at all?
I can hear you now. I couldn't hear you a while ago. Your mouth was moving, but I couldn't hear anything.
Okay, I'm not sure what's going on technologically wise, but I tell you what, send me a message in the chat. Oh, Andy says he can hear me now. All right. I'm not sure what happened right there. I probably hit the wrong button, so I apologize, but it sounds like people can hear me now. So I'm looking at the chat button to see if anybody is sending anything else in. Give it just one more minute. But we appreciate everybody dialing in for a second. And as things pop up, whatever it is, please reach out to us. Plieben Associates is here for you. And we're going to get through this together. And when we do, we're going to be glad we didn't react to all this stuff going on. So please, everyone, stay safe, stay well. Oh, here's one more. Hold on. I've got another one popping up. Oh, thank you. I appreciate it. The people that are saying thank you. So I appreciate you all. Stay safe and stay well. Please let us know what we can do to help, and we will look forward to catching up again very, very soon. Thanks, everybody.